Episode 89. After a run-up in housing prices in the Greater Toronto Area in the 80s, prices peaked in 1989 and crashed by more than 30%, bottoming out in the mid-90s. And congratulations to Rory McIlroy, born in 1989, who was just the 6th male golfer to win the career Grand Slam. Beyond MD, episode 89, here we go! Hey everyone, thanks again for joining me on Beyond MD. A quick reminder to everybody that there is currently an ongoing vote for CMPA Council, and many of you know I am running for a position to do my part to continue supporting Canadian doctors in every way that I can. To those of you who have reached out to me and supported me, I just want to give you a big thank you for keeping me going. And to those of you who have not yet voted, I encourage you to vote, and if you think I would be a good candidate for the role, I'm really grateful for your support. A lot has been going on since Liberation Day on April the 2nd in the stock markets. It's been incredibly volatile, and I think for a lot of us, we have some of the same questions. What should we be doing with our portfolio? And so I wanted to bring somebody on who would be able to share their insights on their investment journey, talk about some of the lessons that they have learned over time, and hopefully calm some minds. So today, I am absolutely thrilled to welcome Paul Healey back onto the podcast. As you all know, Paul Healey is the co-founder of Physician Financial Independence, and he's always very articulate and thoughtful when it comes to talking about investing. I think there's something in this episode for everybody, so without further ado, here's my conversation with Paul Healey. Paul, I'm really excited to have you on, especially with how things are going right now in the markets, because I've been getting a lot of questions. I know you have as well. And one thing I can say is you've been investing for longer than a lot of us have. And I think that your perspectives here are going to be very, very helpful in an up and down time to just help people stay calm. So I wanted to welcome you back to Beyond MD.
Thanks.
I just would love to just start open-ended with what kinds of questions are you getting these days? I expect you're getting a lot, but what are you hearing?
Well, the common things are, I run a big online group with Jane, PFI. Yeah. And so, there's tens of thousands of people there. And inevitably, when you get a market event like this, whether it's COVID or the Trump dump, and you have a big market crash, you have people who come to the group and say, what do I do? Should I sell everything and should I wait? And then, once I sell, what do I do next? And then the other big question you get is, okay, I understand that this has happened before, but what if this time, it's different and it's not what it was before? So those are the two biggest questions, should I sell? What do I do right now to fix this? And then what if this is different than previous things that have happened? What if, I really will lose a lot of money in the long term? So those are the two big questions that always come up at a time like this, inevitably and predictably.
On the sell point, I want to share a quick story, and then we'll get into some of the questions you've been getting. But back in March 2020, one of my friends reached out to me. There were a lot of nerves about those very volatile days. And about halfway into that market downturn, they reached out to me and they said, I really feel like I should be just selling my stocks. I don't think this is going to be good for my portfolio in the long term. Of course, at that time, the right decision was to just stay the course, stick to your plan. And I encouraged them not to do that. And about half hour later, I got a phone call saying that they had sold everything. And then this leads to problem number 2. It's very, very difficult once you've done that to have the fortitude and the gumption to know when to get back in. And so it introduces a whole other layer of problems. But Paul, what I'm finding is people are really, really nervous because they'll look back to history and they'll look back to years like 1929. And nobody knows what this is going to end up being, but people will say after the 1929 crash, it took 25 years to reach all-time highs again. And after 1973 and 2000, it took 7 years to reach all-time highs again. So when people throw out data like that, how do you talk to them and guide them through it?
All right, so it's really important because this happens a lot, right?
Yeah.
And this is selective period picking, okay, which is what people do. They'll throw out a 10-year period or, a 15-year period where things weren't really good. And usually the argument is, look at this 10-year period or this 7 to 10-year period when you wouldn't have made anything. If you'd invested in a certain year, you wouldn't have made anything for that whole period of time. And usually the follow-up argument is that's why you should stay out of the markets and you should, follow up with this specialized investment that deals with that problem. And that's just wrong. It's incorrect. And you need to change your thinking about it, because you have to understand, when you invest, no one invests at one time and then walks away for the rest of their savings career. You are going to purchase investments every single year when you are saving. And when you do that, you don't just have one 7 or 10 year period. You're going to have multiple 10-year periods. So if you're saving for 40 years, you may have 40 different 10-year periods built in. And I know it starts to sound a little bit complicated, but think of it this way. You have a barrel of apples. Okay, when you are done investing, you got a big barrel of apples that you're going to use to retire on. Okay, and each of those apples represents a 10-year period where you got to invest. And some of those apples, a very small number of them, are going to be completely rotten and useless. And those are the bad years when maybe you got a 0% return. But everything else in the barrel is going to be totally adequate and exactly what you need. And on average, all of these time periods, they average out and they give you the return you need to be financially independent or to retire. So you have to be really careful of staying away from that selective period bias, where you decide to look back and pick the worst period and say, oh my gosh, what if that is my entire investing career or portfolio? Because that's not what happens. You get an average of all of these 30 or 40 different 10-year periods that you invest in, because you invest in 2025 and 2026 and 2027 and 2028. And all of that really averages out. So you really have to be so careful about that kind of thinking. And I always, anytime, someone posts that to our group of, oh, look, what if you were in this period? Sure, you will be in that period. And you'll be in a lot of other periods too that are just fine.
I think that's really well said. And some people don't know, but I do have a bit of a money coach at home. And that's my wife, Seema, who I bounce a lot of stuff off. And she's a really good big picture thinker, because I can tell you in 2020 of March, Paul, I was getting a little bit rattled inside when I would see some big red days. And I would come home, I'd talk to Seema, and I'd be like, you know what? Lost a lot of money today. And she just paused me in my tracks and she said, yeah, but so what? Isn't that money going to be there for the next 30 years plus? And I just kind of thought about it. I was like, well, yeah, that's so logical. But when you're seeing headlines left, right, and center, you sometimes can't think all that clearly. So that's what happens at home. And I'm grateful for the sounding board that I have. But Paul, I want to move on to your strategy. Like, do you advocate for investing at regular intervals and basically investing the same amount of money at regular intervals? Or do you like to take advantage of times when the markets are dipping and buy a little bit more aggressively at those times? I'd love for you to shed some light on this.
So the thing is that, my advice is to always just invest when you have money. And for everyone that's going to be different. You may have spending at, a certain time of year that's more than another, and you may have saved less or more. But whenever you have those savings and they're crystallized and they're sitting there in cash, I don't think you should ever sit in cash for a long period of time. So realistically for us, that's probably quarterly. We will, invest. And I have a little bit of a problem with this whole concept of, well, wait, when the market's down, maybe you should invest a little bit more. Because I don't understand how you operationalize that. Because that means you're going to be sitting around with a bunch of cash ready for these downturns. And I don't think that really makes any sense to do that. I think you should always just be invested when you have the savings to do it. And trying to market time by keeping cash around, it doesn't really make sense to me. And I think that anything that you can operationalize, you don't have to think about, you're going to be more successful at. So this whole idea that, hey, as soon as I have a certain amount of money in my account, I invest it, or I invest whatever's sitting in my account, that cash quarterly, then I think that's the way to go. Because the only other way is if you're going to try and take advantage of dips, then that means you either have to be sitting around in cash with that cash ready to go, or you're going to be borrowing money to have that cash to put extra money in when it dips. So I don't do buy the dip, because again, it just starts you on that market timing, slippery slope. And I think it's best avoided. So I don't do that.
Okay. So it sounds like you invest on a regular schedule on a quarterly basis when you have money available.
Yeah.
Okay. Okay.
Regardless, and the other part of that is regardless of what the market's doing, right? So if it's at an all-time high, I'm buying. If the market has crashed, I'm buying. It's just whatever is going on at the time that cash is there is what it goes in, and I try to avoid thinking about it and market timing it.
So it sounds like your regular investment schedule, it sounds like that maybe helps you to take some of the thinking and even emotion out of this process. But Paul, I would love for you to just talk to us a bit more about how do you manage your emotions? Maybe it's just you've been doing this for longer, you have a set schedule, but I'd love for you to elaborate on this.
Well, I think you're right. It's just the first couple times I went through this, I found it hard. The first time was the hardest in 2008. COVID, I found a little bit more stressful because it just felt like in our lives as healthcare workers, there was the other sort of unknown that was going on there, with COVID and worry about getting COVID and that sort of thing. So I found that one more stressful. I have to admit, I'm not very stressed out by this particular event. And I think it's just the fact that I've been through it before and I know how this goes and I've done enough reading and I understand that this is the way the market works. And this is actually something that has to happen, for you to do well, because you're going to have down periods where you buy at a discount, and that in turn improves your returns later on. So I don't get too worried about it anymore. And the other thing that, to be honest, is that we're just more comfortable. We have more money, we have more savings. And so it was harder when it was earlier in my investing career, and you feel those losses more because it's a bigger deal. But if you have enough, it doesn't seem to hurt as much.
Paul, you mentioned you've done more reading. Are there any resources specifically, like any books that you read that, because I think that the more knowledge you gain, I do believe that can help all of us to kind of go through these scenarios with more calm and more conviction. Mm-hmm. Any books or resources that you're willing to share?
Yeah, I honestly, I don't have a ton of books that, that I would recommend to people. I think, even in our group, I've kind of adopted more of this. I like articles and links to good sources now. Sitting down and asking someone to read a whole book in 2025 is often really hard to get people to do. So, I don't have a specific, resource. I think that I used to really like Bogleheads as a website that I would go to, and there were so many good links and resources there. John Bogle, and certainly you can read his book as well if you like. But I think the thing about it too is that it's all boiled down and just been distilled down to simple concepts for me now. The buy, hold your investments, chill out, ignore the noise, and in the end you'll have significant returns and significant growth. And so I don't find I have to read or think that much more about it anymore. I think that usually works.
Can I just rewind to 2008 and 2020? Like 2008, I imagine would have been maybe in the earlier days of your investment journey, but were you able to do what you kind of encourage others to do now, which is just buy at regular intervals? Because I find for myself, like those first few drawdowns that we all go through on our journey, they could be really, really tough. Like, were you doing the same things back then that you do now?
I did it, but I did it by accident. I'll be honest with you.
Oh, really?
Yeah. Well, the whole thing is I started investing in 2007, right? So I was, newly practicing, as a physician, and, I had, a child at home, and, I had a mortgage and that sort of thing. And we were just starting to invest. And so I had read about, index funds and low cost investing. So I was doing that part of things right. And I had this money in there, and I was kind of proud that I had done this. And then 2008, 2009 comes along. And, here it is. I told my wife that, oh yeah, no, I know what I'm doing. And I've read and and this is not good. You got a new house, you got a child, and you have to, provide for your family. And here you go, you've lost, 30% of all of that money that you've worked so hard for. So that was really hard. And so I was in this situation where honestly, I just didn't know what else to do. And I wasn't going to log in and sell. And I was a bit paralyzed, but I was paralyzed and I did the right thing when I was paralyzed. So I just didn't sell anything. And I just kind of kept buying and thought, well, I guess it'll go back. Maybe the market will come back. And of course it did. So I did the right thing, but I did it by accident. I can't say that I had any great insight and knowledge at that early part of my investing career, but yeah, that's just what happened.
Paul, good for you, because I can tell you that if that was the first drawdown that many people were to experience, I don't know if everyone would have acted in the same way, but it sounds like you went in there with some knowledge and some poise, and so good for you. But I just have to share these numbers. I was doing a bit of reading an article that Andrew Hallam had published, and I worked through the same numbers using a compound interest calculator. So I'm just going to quickly give scenario one, and maybe this will help to give people some calm. But let's say you invest $10,000 a year for the first 15 years. You're investing that $10,000 and you're getting a 15% annualized return for the first 15 years. You continue to invest $10,000 and you get just a 2% annualized return for the latter 15 years, so 30 years in total. That results in a nest egg of $920,000. Now, I want people to just compare this to scenario two before I give the answer. Let's say you're doing the same thing, $10,000 per year, just investing it. For the first 15 years, the returns are only 2% a year. And then for the next 15 years, the returns jump to 11% a year. Which scenario? Scenario one, where you had incredible returns right off the bat, versus scenario two, where you have very meager returns early on, but then better returns later on. What ends up giving you a larger nest egg? And remarkably, scenario two, where you had some really bland years early on, but better returns later on, you ended up with a nest egg of $1.2 million. And I thought of this because what you mentioned, you were investing through some really difficult times, but because you kept at it regularly, that money has more time to grow. And as the prices went down, you were giving yourself better opportunities for the long run. So I just wanted to share that with some people. And if people are wondering, what if you have just 7% annualized returns the whole way through this 30-year scenario? A nest egg of 1 million. So the person who did best was who stuck it out in those early tough years. And it reminded me of your scenario. So
yeah, no, it's really important to understand that, like this is the thing, everyone panics about a stock market crash, but really that was a huge benefit to me as an early investor, because yes, I lost some money. I had money in for a couple of years and then the market crashed, but that gave me a nice long period to continue to buy, investments at a discount. So you have to understand that this is how it works. These down periods are where you are getting an opportunity to buy the number of shares that you need to retire on, whatever that number of shares is, and you're buying those at a discount. And it's the old, as the saying goes, you don't have to run out of the store just because everything is on sale. And I think that's the way it is with, investing like this. When the markets go down 15%, 20%, that's not your time to, sit in cash. That's your chance to just keep buying.
I'm really glad you mentioned that, because I heard a quote recently where somebody said, the stock market is the only store in the world where a sale scares people. And it shouldn't. You should just kind of continue on. Okay, common practices. You talked about investing money when you have it. I think for some people, I know I'm one of them, like just for me to say that, okay, let's say if I have 80 or 90% of my money invested at all times, if I have a little bit of a cushion, that just helps me to kind of stomach downturns more mentally. But you've already kind of mentioned you're not a big fan of having chunks of cash on the side. I would advocate for people, of course, having an emergency fund. What is your take on all this? Because somebody may ask you, like,
yeah, I'm not a fan of the emergency fund, honestly,
really?
because I'll tell you why. I think you talk about it being your cushion, your little cash cushion. Yeah. All my savings are my cushion, right? If I have a situation where I need money, where I had an illness, or I had a big disaster in my family, all of my money is there for that purpose. That's what money is for those big bad things that happen. And so, the other thing is, we're lucky. We're physicians, and we're higher income earners. And I think if you are someone who is living on a lower income, I think that's really critical. The idea of having the sort of the financial cushion, or the cash emergency fund. But I have kind of stayed away from that, because I really view it all as emergency money if I need it, that I would just access, and regardless of tax implications or whatever, if I If I
Okay.
need it urgently, I need it urgently. And I do find that it's a bit artificial to just kind of put this aside and say this is the emergency money when really it's all there. It's all there to use.
I guess the only other question I would have around that is like, let's say if all our money was invested and there was a bit of a downturn, something unexpected happened in life, one may have to kind of sell out at a time that may not be the best time to serve their personal needs. If I push back a little bit, do you have a take on that? Maybe that scenario has never really come up, but what if somebody was to approach it that way?
Well, I guess you could look at what your alternatives are, right? So you have, first of all, you have distributions. If you've saved significantly, you will have distributions, every month that you may be reinvesting that you decide not to reinvest. If you need it on a really short period of time, you may have a line of credit that you want to access. So all of those would provide enough cash in the short term, for me to do what I need to do. If it gives you psychological safety and it gets you there, absolutely. I think that's fine. I guess my argument is it's a little bit artificial because it's really all there if you really, really need it in a bad situation. That's the other thing, is that I kind of view this money as it's my money, and if something bad happens and I have to fly to the United States for emergency medical treatment or something like that, I don't care. I'm going to spend that money. That's what money is for. So I'm not worried about if the market's down or whatever at that point.
Paul, one question that's coming up a lot, people are like, okay, if I'm going to go invest now, do I lump sum essentially most of it today, or do I average it in over time? When faced with that question, what would you say?
Well, I think the thing is, when you have a question like that and there's good evidence to support the answer, you go with the evidence that has good answer. And, you can go and read, and Vanguard has put out a very good paper about lump sum investing versus dollar cost averaging. And the evidence is pretty clear. 2 out of 3 times, lump sum will beat dollar cost averaging. And the reason is that in general, the market is, for the most part, on an upward trend most of the time. And so, putting money in 2 out of 3 times will beat trying to put it in at different intervals and dollar cost averaging. So I try to just keep it simple. It's this whole idea of when you have money, invest it regardless of what's going on in the market. Don't make a decision about do I DCA or lump sum based on what's going on with the news. Again, it's irrelevant. Just lump sum. Like if I were to inherit or have a big windfall of money right now, my strategy wouldn't change. I would just put it all in at the time that I have it. And I'm totally comfortable with that. Because again, it's about your time frame. If this money is going to be there for 20 years, I don't care what happens in the next 6 months. If I could have got everything 3% cheaper than if I had dollar cost average. So the thing with me is I think it's good behaviorally because it takes your thinking out of the equation. And it makes you do the right thing, which is just invest and, don't second guess and don't become paralyzed.
What about which ETFs to pursue? I would think that most people that I know would probably benefit from a one-stop shop ETF where there are fewer moving parts. Some people may want to finesse that a bit and have a basket of ETFs. Any thoughts on that? And if you're willing to share what approach you take, I think it would be of interest to listeners, understanding that we are not trying to impart advice, just more common sense. But
yeah, it's a really good question. So, I have, my portfolio is a whole bunch of different ETFs, right? And I have to go in and figure out, how much I have of each and sort of do my own asset allocation. The reason it's set up like that is because when I started out, there were no all-in-one ETFs. So I'm kind of stuck with that now. You'd have to pay capital gains if I wanted to switch and go into an all-in-one fund. But I think that anyone starting out, I think the all-in-one funds are great. It just takes all of the thinking out of it. You log into your brokerage account, you buy that one fund that has your entire, portfolio in it. And then in 3 months, you log in, you buy the exact same thing again. And I think it's incredibly beautiful and incredibly powerful to just be able to do that. And if I were starting over again, that's what I would do. But I'm in a situation right now where I have lots of ETFs. Maybe I make a little bit of a cost advantage by kind of doing it myself and buying these individual ones. But I think they're incredible products, and I don't care who you get it from. There's lots of companies that are doing the all-in-one funds, then any of them are fine.
Yeah, no, I agree. And I was looking at some evidence that Andrew Hallam had laid out in his book Balance. And his finding was that the fewer the moving parts, the better the behavior, the less there is for us to do, and the better the returns were for the average investor. It was interesting data. Paul, as time has gone on, has your asset allocation, like stocks to bonds, anything like that, has that changed over time? Would love your take on it.
Yeah, it actually has, because I think the evidence as far as what to do is changing. Originally when I started out, I was probably carrying a lot more bonds. I think I was starting out 70-30, when I first started investing. But I'm starting to be convinced more and more by the evidence now that you may not need a lot of bonds or any bonds in certain circumstances. So I'm starting to find that evidence more and more convincing. So I carry, far fewer bonds as a percentage of our whole portfolio than I used to, and I'm far more comfortable doing that.
I want you to just shed some light on the power of compounding and like sticking with our plan and like time in the market. Like, when was it in your investment journey where you really saw that power of compounding? Because we see 2023 and 2024, 20 plus year returns each year. That's not really normal. Whereas I'd love for you to just talk to us about, when did you really start to see like your efforts going to take off with your portfolio?
I kind of think really, at about sort of the 15-year mark, maybe less, maybe the 12 to 15-year mark. And it happens obviously, slowly and then very quickly. You're used to kind of getting small distributions, and you log into your account. But then once you start to, get to that sort of point, you really start to see that exponential growth. And the returns that you're getting, obviously, if you're getting, 6% of, a larger number, that money that's coming in, you're used to it in the terms of what does it cost me to live? And then you start to realize that this money coming in you're like, wow, that's significant. And it's very hard for our brains to get our heads around nonlinear growth. We're really good at linear, at thinking of the line and understanding that. But, exponential growth, this whole idea that, next year is going to be, 2 times or 1.5 times better than the previous year, relative to the amount of cash coming in is really hard kind of until you sort of experience that. And so that was sort of the point where I started to realize, wow, this is significant, and it really does affect your portfolio over the decades. And when you hear of people who are 70 or 80 and having these large portfolios, and you think, how did they ever get there? Well, they probably got there in the last couple of years or 2 or 3
I know.
years
It's so true. It's so true.
of their thing. They didn't have that for most of their life. But the 80-year-old, there's all these stories you can pull up on the internet of someone who dies in their 80s, and someone goes to a safe deposit box and finds all the stock certificates, and it turns out that they were a millionaire, and they were probably just a millionaire for the last 5 years. Well, maybe they were a millionaire before, but you know what I mean about having all this incredible wealth. And that's the way it works. When you invest, everyone thinks about, the next 5 years, how am I going to do the next 5 years? You are investing for the last 5 years, in your portfolio. And that's when you're going to see, the really sort of incredible numbers.
Okay, I have to share one story that is tied to that exact last point you made. So this was several months ago. Somebody had tried to call me through hospital locating, and I was actually on vacation. And I saw the hospital was calling me. I picked up, and it was this retired physician from out of town who called. They had a question, and they had told me that they were very fortunate, and they had played the long game with investing. They had thought very long term. And I asked them what they had done, and they shared one specific example. This individual said they bought a share of Berkshire Hathaway back in 1989 when it was $5,000 a share. This is Class A. And then had held on to it for 36 years until 2025. And so I tracked it, and I've shared this in 3 presentations. And every time I look at the share price, it just keeps going up. But the remarkable thing, Paul, was that more than, I would say about 2/3 of the returns were in the last 5 years. Like that one share price had skyrocketed
Mm-hmm.
from $5,000 to the last time I checked, it was $790,000. It's probably gone down a bit since then. But the whole point is the majority of that return came in the last 5 years. And that is to me the power of compounding and playing that long-term game. And playing that long-term game becomes much easier when we start today. So I just want those numbers to kind of sink in with the listeners. And as we wrap up, Paul, is there anything that you want to touch on that we haven't touched on today?
Just that I think that there's a lot of really important concepts that we talked about today that you just have to internalize and remind yourself of when these sorts of things happen. That, you are investing for the long term. And almost everyone is investing for the long term, even if you're 50 or 60. You could live to be 85 and you may have another 25 years still in your investments. So you get a lot of people who are later on in their career and they're saying, yeah, but this stock market crash is different for me because I'm older. I'm going to retire in 3 years. But the truth of the matter is that, yes, you're going to retire, but you don't cash out your whole portfolio the day you retire. Mm-hmm. You're going to take some money out, and a lot of that money is still going to be there for 2 decades. So there's really no need to panic. You're going to buy your investments. You're going to hold them for a multi-decade period. You don't care what happens in the next 6 months or a year. You only care what happens, 20 years from now when you need that money. Markets have recovered. If you look at most graphs, most stock market crashes, we recover from them. With the exception of a very small number. If you look at different geographies, if you look at Japan, yes, you can pull out a graph of how Japan took a long time to recover, and I agree that that's true. But the vast majority of cases, if you have a stock market crash, we recover from it. And that is a huge opportunity for you, that down period, because you are buying all the shares that you need to retire and you're buying them at a discount. And it's really just about, controlling your emotions. And the people that do best are the people sometimes that just forget or aren't interested or don't check. And those people kind of set themselves up for success. And sometimes too much information and our tendency to think that we're too smart and that we know what to do, it misleads us and kind of, leads you into danger. So I guess be lazy with your investments, buy them, leave them alone, and, chill out. And in the end, this will work out very well for you.
Paul, I think that's all really well said, and I think will be really well received. I just want to thank you again for making time for us. I think this is an important message that I hope a lot of people will hear, and just thanks for all the good work that you and Jane have done over the years.
Thanks, Atten. I think it's great that you're doing this when people are panicking the most, and we give them a nice short little, pep talk, half an hour. Hopefully keeps them from logging into their brokerage account and selling everything.
I hope so. Yeah.
Yeah.
Awesome, Paul. Thanks again. Have a great one, okay?
Thanks a lot, Jan.
So guys, it's been quite the week, and earlier this week I had a bit of a realization. So on Monday, my oldest son Rohan, who's 10 going on 11, he had his very first track meet, and leading up to the event, he asked me, he said, "Dad, will you come and watch me at my track meet?" And I said, absolutely. So I had to really set up my schedule to make this happen. I booked off a day well in advance, and if you guys remember from the last episode, I don't have the highest time wealth score, and it's something that I continue to work on over time. I was able to take this day off, and I was able to be there for Rohan, and I was so excited to see him in action. I was able to catch him on video in 3 heats in the 50-meter dash, and he was able to win his last heat. I was so proud in that moment, and I realized, had I not been there, this is something that I would have missed out on. And when I look back to the conversation that I just had with Paul, why we talk about investing, I think it really boils down to this. Every investment that we make today, these are seeds that we are planting that are going to grow into trees of time freedom in the future. This is why we practice delayed gratification now and invest today for more time freedom in the future. And it really helps me to think this way because it brings to reality of time being our most valuable asset. So to everybody, thank you for joining me and happy investing. Try to think long term. And I think if we do so, I think we're going to be okay. We'll see you in a few weeks. Until next time, stay well, stay savvy.